There are two news that are possibly very encouraging for the rest of the year. First, Morgan Stanley is maintaining a price target of $320 for Tesla stock, but what is even more exciting is their message to investors. They believe the theme of humanoid robotics will accelerate in the months and years ahead. And a big surprise, new data from Cox Automotive is showing that sales of new vehicles actually went up in February. But what is shocking is that the average day supply of inventory is still quite high at 76 days. And which automakers are faring the worst? Yep, it's the domestic automakers, Dodge, Jeep, Chrysler, Ram, and Lincoln. So I've got Jeff Lutz here with us. He's an ex-supply chain executive at previous Fortune 500 companies. Thank you so much, Jeff.
Yeah, I love these types of discussions, Herbert, because it really gets into me, like looking into the supply chains of these companies. You really understand what the trends are and what's actually happening, because we'll get into some of the data. I think the data is really helpful to understand what's going on in the auto market.
Yeah, it's important because I think people think that the auto market for Tesla is a done deal. It's going to be down. There might be signs that it might be different if you look at the new sales, but also you've got data as well to share about the used sales. In the meantime, Morgan Stanley, let's start with that story. They maintained their price target, but it's really interesting that even here, institutional investors now talking about bots, even though they haven't included it yet in their price target, but at least they're keeping their eye on it. So we've got a Morgan Stanley new note that Adam Jonas dropped. It's titled On Bots. And he goes, our $320 price target for Tesla is comprised of auto-related, and energy-related businesses. So they do have software and services, which includes FSD. While Tesla's competencies in computer vision, machine learning, AI, and robotics may have a multitude of adjacent commercial applications, we've not included such revenue streams, including Optimus, in our model or valuation at this time. Before I move on to his thoughts about bots, what's your reaction to just this how they do this?
Yeah, you know what? It's interesting. Tesla is going to be a very difficult company for some of these investment analysts, sell side, even buy side analysts for them to analyze, because they don't fit in one category. There's auto, there's energy. Now you've got humanoid, you have AI, you have humanoid robotics. Arguably, they're threading across 4 to 5 different areas, and that actually makes it quite difficult and slow. I would say, for some of these companies to really come up to speed. If you look at the analyst notes from the past week or two, everything's just about units and current quarter. And Morgan Stanley and this Adam Jonas team are probably one of the only teams that starts really looking much further out. And I would say obviously ARC does as well, but they're not connected to a bank. But in terms of these analyst firms that are connected to investment banking, they're one that actually kind of looks out in this, but the rest are kind of just looking at like current quarter. So what I anticipate is happening right now is like the work that you've done, Herbert, and CERN and Scott and Dr. Noel. You guys have done great work, and I believe it's being watched, it's being looked at right now. And I think these companies are probably working on bot stuff in the background, but it's probably going to take them, throughout the better part of this year to get some of their analysis out. And the question will be, from Tesla and others, like, what time frame does this actually impact the business? And that's the other thing. They tend to be more focused on, what's happening over the next 6 to 12 months. That's where that 320 price target comes from.
So this is their message to investors. Prepare for the theme of humanoid robotics to potentially accelerate in the months and years ahead for a number of factors. We recently discussed our thoughts in a December note where we discussed mobile AI as akin to Cambrian explosion. Mobile AI is like different kinds of bots. So they're expecting it to come, but I think they've been shocked with as many of us, every single week this particular year, there's been drops of new demos. So their image that they shared here, which is, there's the rise of AI, there's a labor shortage. And then this is like, they think that there's going to be more money thrown at bots or companies that have a bot future to investors, because with Apple slowing down their AV progress, they think that the attention has now switched to bots more than it is on autonomous vehicles. I don't understand that part. Let's dig a little closer. So let's start with this. Investors may have noticed a marked increase in announcement, technical demonstrations, and capital formation in the area of humanoid robots. So Figure AI raised $675 million just a month ago. Investments by Jeff Bezos, NVIDIA, Microsoft, and OpenAI. Our industry discussion suggests Tesla's CEO Elon Musk is spending increasing amounts of time focused on Optimus. That's great. I wonder what that means. Industry discussions. Do they have some insider knowledge? Are they seeing something more than we have seen? The Chinese government is stepping up support for the development and commercialization of humanoid robot technologies. So we've reported on that also. Chinese have stepped up, saying that we are going to become the leader in humanoids by 2027, and they're going to put their full backing on it. What has changed to make this seemingly novel topic so consequential? Any thoughts on that first topic? Or we're going to go through the three things that has changed, but just before we set up, what's your thoughts on that?
Yeah, I mean, my thoughts is that Tesla is looked at as a technology leader in the industry, and 2 years ago they stepped out and said, we're going after this. And I can't think of another major company that that said that they were doing that. And then Boston Dynamics at the time was kind of doing more of these demos and non-AI driven bots. So I think Tesla really led the charge in that conversation. And then also just the acceleration of AI and generalized AI, I think is also helped driving this conversation. And it's going to further accelerate. And the analysts are going to be behind. They're not going to call this correctly. They didn't even call the NVIDIA ChatGPT stuff that was widely out there in the open. Jensen widely talking about the explosion and what's going to be needed in terms of compute capacity. And they were, that stock at $120 a share in November of 2022. So these analysts are also going to be late on humanoids. I'm confident in it.
Oh, they are. And so this is the interesting thing, like you said, right? Tesla announced this 2 years ago and no one was doing this. They saw this. They knew it was right timing. They're now ahead. And of course, everybody just ignores it. Oh, whatever. Now they're showing you it's working here. I don't know how you bet against Tesla. And then the investors are starting to flow in, and now there's the interest. But you should have been ahead of it. And that's why retail investors have a little bit leg up here if you have a little bit of guts. Mm-hmm. So let's walk through the three reasons he thinks that we're going to see a lot more humanoid interest in the next several months. And by the way, the beneficiary of this is Tesla, because if you want to invest in a humanoid bot company, the only one you can at this point is Tesla because they're publicly traded. Everyone else, except for maybe a couple others of the whole list of 22 humanoid bot companies, you have to go through a Series A, B. It's not accessible for the regular investor. So as you said, there's been an AI revolution, right? Faster progression than ever before it. LLM, compute power, all of this is going to be transferred to the advancement of AGI and robotics. Then there's labor shortage, okay? That people don't realize that there's been a massive labor shortage, even pre-pandemic levels of 1.7 million Americans missing from the workforce. There's the 9.5 million job openings versus 6.5 million unemployed workers. So there is a labor shortage. And then, of course, this part I don't understand, but basically they're saying that with the interest slowing down on autonomous vehicles, well, that's because of the issues with Cruise, and then Apple's decided to cancel their autonomous car projects. People are now going to start to redeploy their investments into bots. That's what I was thinking. Comments on those three things.
Yeah, I mean, they can prescribe those three areas as potential things. This EV slowdown. Which EV company is reinvesting in bots? I mean, Tesla has been investing in bots, and they're increasing their investment. I can't think of another EV company or even a company with EV assets inside of it that's a legacy auto company that has some major bot program that's underway. So that one to me doesn't make as much sense. But the labor shortage is real. This has been going on for a long time. This actually isn't a recent thing. I mean, I've built even in the mid 2013, 2014 timeframe. And the type of people to do kind of manual labor, especially any kind of microelectronic assembly in the United States, for example, those resources have been gone for decades. Many of these industries moved out in the 80s and 90s and moved overseas, whether it's the rest of Asia, then eventually the ramp up of China. And we haven't had, that type of resources, and again, in mass quantity, where you can just go to a city, go to Fort Worth and say, I want to start, microelectronic factory building tablets and phones. I need 5,000 people, and you can just have a job fair and hire them all and bring them on. You can't, people think you can do that. You can't do that. You'll get a couple hundred people, and then you'll be trying to figure out how to, go wider and try to get more and more people. It's very, very difficult to hire people to do a lot of the kind of these manual repetitive labor type jobs. So that's the other, I think there's truth to that. And the only thing I'll say is that it's been going on for a pretty long time.
So that's the first potential good news. That's maybe in the next months, maybe next year, people start looking at Tesla as a bot company, try to get ahead of the game, invest. Some people think it's not going to be a lot, but I personally think it's has a real chance as the excitement in society starts realizing this is becoming real and real and real, and they want to get ahead. We'll see. But the second big potentially good news. These are just very potential. There's been new data from Cox Automotive saying that February sales have actually increased. You pointed this out. So this is good information to share to our audience, right? February sales drew down new vehicle inventory. So the weak January sales pace led to an inventory buildup of 80-day supply. That sounds like it's close to all-time highs. Stronger February sales drew down inventory to 76-day supply. So that's good news. This is new sales of all cars. Toyota was still short on supply, nearly half the industry average, a 34-day supply. So they're good. They're doing well. And I think you'll tell me that Tesla's still at probably 17-day supply. So they were
at 15 and they were 15 in Q4. Yeah, they're half of Toyota's seen as the best auto supply chain in the world. I would say non-EV. Again, outside to me, Tesla isn't the best supply chain in the world, but for years, for decades, they've been seen as the best supply chain in the world. Part of it is their inventory. This velocity of inventory is a very important thing for a supply chain. So if they're in Tesla's half of what they're running at, just to put it in perspective. But I think this whole story, like how this fits together with we were just talking about with Jonas. Jonas says, look, $320 price target for Tesla. Very small portion of it and declining portion of it is going to be the auto side of it. The rest of it's going to be in this work that they're doing on AI, autonomy, energy, humanoid robots, and it's everything else that Tesla is doing. It was encouraging to see in this Cox data, and this is the new car data. So it looks like the new car sales were starting to ramp up at the end of February. This is the U.S. data, starting to ramp up at the end of February. And also there was another report that came out in parallel that said the used car inventory drew down significantly. And I think it was around 44 days of inventory. So these inventory levels are still elevated. They're elevated versus the prior year, I think by like 50%. But it's nice to see them sequentially. It's just another month data point. I think we need to see a couple more months in a row. But now as spring is coming on, this is seasonally a better time for auto sales. So hopefully this, there's some green shoots in here for Tesla, because what have they done recently? They've gotten all their vehicles to a price point that they believe is competitive. In fact, they've elevated. This is what people don't talk about. I think there's been more price increases on that Tesla's posted in this quarter and for April than decreases. And so hopefully Tesla's finding stability here. And with the $7,500 credit and everything else, hopefully the awareness is getting out there, and things are starting to settle in. We've also seen them increase prices in Europe as well. I think every inventory is going to have their own challenges. I think in this first quarter, the biggest challenge I think for Tesla was the transition over to Model 3 in North America. I think they may have lost we'll see 35 to 40,000 units. And that'll be kind of, to me, the bulk of the story. I think the rest of it is pretty on the margins between Europe and China. So we'll see. But this is a little bit encouraging news to see the inventory drawdown. Because if inventory kept building, this is a bad thing in this industry. If your inventory is building higher and higher and higher, you'd start seeing massive plant shutdowns and furloughs of auto workers across the nation. So this was encouraging to see a kind of a sequential drop, and then also to see the drop in used car inventory. That means people are, starting to soak all this, back up. Spring's coming in, tax refund checks are coming in, and people are going and buying cars. So I think it's a good sign, and it may hopefully put a floor under what's been happening lately in the auto industry and with Tesla.
Yeah, exactly. So this is a nice table that shows in February the supply of inventory by brand, and Dodge, Lincoln, Genesis, Volvo, Infinity, they're the ones that are suffering really poorly here. They've got so many, 133 days. That's crazy.
It's over 4 months. That's just selling. Dealer. Yeah, that's dealer inventory too. That doesn't account for their own factory inventory, and then their inside of their supply. So what happens is when they see that 133 days, they go tell their suppliers to slow down. And when their suppliers slow down, their utilization rates drop, and the utilization rates drop, their costs go up. And so their ability to go get COGS reductions out of those suppliers becomes that much more difficult. That's why this inventory piece is so important. That's why also, if they have a cost reduction idea that says, hey, I want to go, and I want to go and combine these two parts together, I'm going to save $100 a car by doing it. It's going to take them, they got to sell 133 days worth of vehicles for that $100 price reduction to roll into production and to see it out there. And they've got their own factory inventory. They may have over 6 months before the time they come up and implement an idea in the factory to the time it actually rolls out. And then, so it's becoming, that's why this inventory piece is very important. It's good to see it drawing down a bit.
This is weird. Okay. This graph is wrong. So they don't even show you Ram, Chrysler, Jeep, and Dodge. They don't show that to you because they have days of supply at least twice the industry average, which is 76. So 152. It's like they'll be way up here and they don't even show it to you. It's crazy. What a weird graph. But okay. So so this is crazy. And then you got this. So in March, right now, 2.74 million cars in the US is sitting in inventory. That's average of all the cars is 76 days supply. They're sitting there for 76 days, and the average listing price is 47,000. So, people are not wanting to buy these cars. But in February, you saw that it jumped up. So people are starting to buy cars again. And again, if you look at Tesla, they look like they're going to be the bigger winner here. And this just means that many of these car companies are suffering. They're going to be, this has been sitting here for too long at this point. So they're going to be, that's why they're cutting what they can produce out there. And this is not even EVs. This is just cars in general, new vehicles in general.
All cars. Yeah. So, So let's see, it's 1 month of data. I think we need to see a trend, see a couple more months of data roll in, but it's good to see at least the used car and new car inventory starting to draw down a bit. That's good versus it ballooning up more.
Yep. Well, these are two small stories, but they're important to keep track of the information and data. Hopefully they will turn into something positive, but we're grasping at this point for anything kind of like, for the rest of the year. Otherwise, it will be a boring year. We'll see what happens. But thank you so much, Jeff. Follow him on X, the Jeff Lutz. Thanks, everybody.
Thanks, everyone.
I've created a website that is the most comprehensive resource for the Tesla investor. Please check it out. Simply go to my website at herbertong.com.